As it seems more and more likely that we're heading to a recession, a lot of people are wondering, how will a recession impact interest rates for a home loan? That's what we're going to talk about on today's episode. Hi, I'm Josh Alexander and your host of Orange County Housing Market News, your one-stop shop for all things Orange County real estate. So on today's episode, we're going to go over what you should expect interest rates to do if we do enter a recession in the next couple months in the U.S. housing market. So let's go ahead and get into it. So the latest inflation data was just released, and again, we broke last month's record, and now we're sitting at the highest inflation that we've seen in the US in over 40 years at 9.1%. So this means the cost of goods and services is skyrocketing at this point, and pretty much everybody is noticing this. You go to the grocery store, you go to the gas station, it costs more to do everything right now. So what are the feds doing? They're trying to increase interest rates in order to help calm inflation, but by increasing interest rates, they're also making it more expensive for things like credit card interest rates, car interest rates, and home loan interest rates as well. So everything is costing more. So what this means for the average American is that it costs more to do almost everything right now. So people are starting to spend less money, and that ultimately leads to businesses making less profit, and then people starting to lose their job, which is what happens during a recession. Now, obviously, the impacts of a recession on the US are huge, but today we're going to specifically look at what recessions do to mortgage interest rates. So if you're thinking of buying or selling a home and you're kind of skeptical because you don't know what's going to happen around the corner, let's take a look at some of the data to show you what you can expect interest rates to do during a recession, and then we'll go over some of the reasons why you see that. So first, let's go ahead and look at what's happened to interest rates since 1980 every time we've had a recession. So I'll throw a graph right up here. If you're listening to this on podcast instead of watching it, I highly recommend you head over to my YouTube channel so you can check out the full graph at Orange County Housing Market News. That way you have a better understanding what I'm talking about. However, I will give you the gist of it as we go through it here. So if you look at this graph up here, it's basically going over every recession that we've had in the US since 1980, how long they've lasted, and what interest rates started at, and then what interest rates finished at. And as you can easily see here, every single time we've had a recession since 1980, interest rates have started high and then ended lower at the end of the recession. In fact, if you look at all of the recessions that we've had since 1980 and you average them together, we've averaged a mortgage rate drop of about 1.8% during recessions over the last 40 plus years. So is this a guarantee that the next recession you're going to see that same result? No, but when 100% of all the recessions we've had over the last 40 years, we've seen interest rates go down, it's highly likely that you're going to see interest rates drop as well. Now, why is that? Well, it's fairly simple. The reason that we see interest rates drop is because during the beginning of a recession, we typically see inflation pretty high. And when inflation is high, people are spending less, and the Fed is increasing interest rates. And I've said this a lot on this channel, but inflation is the enemy of long-term interest rates. So as long as inflation goes up, you can expect interest rates to go up as well. However, once we get to that peak inflation number and you start seeing inflation go back down again, you can expect to see interest rates drop as well. On top of that, as inflation gets under control, the Fed is going to want to encourage people to start spending money again, so they lower their rates as well, which just further encourages interest rates to head down more, which makes it more likely to see lower interest rates at the end of a recession than you see at the beginning. Now, the biggest unanswered question here is not what interest rates are most likely going to do, but how long is that recession going to last before interest rates start dropping? So unfortunately, I don't have a crystal ball. However, if you look at the data from the last recessions that we've had over the last 40 years, you can see that typically recessions tend to last about a year or so. So if we are in a recession right now, or if we're going to be in one very soon, again, this is not a guarantee, but there's a likely chance that by the end of 2023, we could be coming out of that recession, and maybe that's when interest rates will start dropping a little bit more. So now that we've covered a lot of the historical data on what to expect interest rates to do during a recession, how long recessions will typically last, the last question on a lot of people's minds is, what should I expect home prices to do if we do in fact go into a recession? Well, I'm glad you asked, because a few weeks ago, I actually did a whole episode on that exact topic. So if you want to check that out, if you're watching this on YouTube, check out the video. I'll link it right up here above, or if you wait to the end of this video, I'll link it there as well. If you're not watching this on YouTube, again, I recommend you head over to my YouTube page, Orange County Housing Market News, and you can get all the information there. Now, before we wrap today up, if you are finding this content useful, can you please do me a favor and make sure you hit that like, subscribe, and that bell button below if you're watching this on YouTube. That way you're notified every single week when I release new episodes. So until next time, stay healthy, stay happy, and I'll see you on the next show. Bye.